Welcome into August. Welcome to Cup of Joe. I'm Mike Carrazzo, content manager here at Ryerson. Welcome, everybody. Thanks for spending your day for a little commodities update here. And as always, we have Nick Webb. Nick, how you doing?
Mike, I'm doing great. How are you?
Doing good. Doing good. And today, like we've had a lot, we've got a special guest with us today, Brian Crane. He's the product manager, carbon flat roll and plate for the West region here at Ryerson. I'm going to talk a little bit of plate. Brian, welcome to Cup of Joe.
Thanks, good to be here.
So, a lot going on, and I thought what would be a very interesting way to start this off is because there's not much on TV these days. I've been binge watching old episodes of Cup of Joe. Apparently, I went back to last August. And just for some context, kind of what a difference a year makes. The theme was we're looking for a ceiling on carbon prices, and that's a much different story today. I mean, look at that step up from. I think this is comparing what U.S., Chinese, and European prices. What do you think of that, Nick?
Yeah, it's incredible. And what's maybe just as interesting is that's last August. If you went back 2 Augusts ago to 2020. That would have basically been the trough of the entire COVID cycle. So that would have been when we saw hot roll prices dip as low as $400 a short ton. So yeah, the Mount Everest cycle that we've seen in steel has just it's been amazing to watch over the last 2 years, but here we are.
Yeah, I thought it was good context. I mean, because with Brian on the show today, we're going to talk about, we get a lot of questions about that deviation between sheet and plate as well, right? So, and we're going to address some of that. You know, just anecdotally, some other things that came up in that episode. Chrome was struggling because of geopolitical tensions in South Africa. We had just hit the Russian export tax with aluminum, so there was definitely a lot going on. Just interesting to kind of see what a difference a year makes. And of course, in clean cut Nick Webb over here, things were very good a year ago, right? Where now you've kind of let yourself go.
Yeah. Probably need to get back on track here soon.
Over to you.
Excellent. I'll go ahead and share my screen real quick. So as always, we have to give you the safe harbor provision. These are the opinions of Nick Webb, Mike Carrazzo, and Brian Crane, who is our guest host today. Take these for what they're worth. It's not investment advice. But we're doing our best here on this end to give you the top of mind information as we see it. First and foremost, on the macro side of things, I might have to issue an apology here because for the last 2 or 3 Cup of Joes, I've been yelling that everybody's got it wrong and that we're not that we are in a recession, while everybody else is saying that we aren't. Fast forward to where we are today, we did in fact get 2 negative quarters of GDP. Downward moves, which in my eyes, or at least based on my previous understanding, was one of the signals of a recession. So there's a potential that in fact first half under some definitions is in fact a recession, which means we're already in one. Now, that being said, if you've been watching any of the news, you've been reading any newspapers recently, you've probably heard that we are not in fact in a recession. And that that school of thought comes from the idea that, as you see here in the top left corner, recessions officially have to be declared by the National Bureau of Economic Research, or NBER. So what is their rule to whether or not we're in a recession? Well, there isn't really a rule. So, it's based on some soft idea of a period of time of softening of economic conditions, but there isn't really any one hard, fast thing that they're citing or that they will cite if and when we do officially go into a recession per their opinions. So with that said, I think we have to kind of put a little bit of a kibosh on whether or not a recession even matters. Because if it comes down to an opinion of a group of people to determine whether or not we're in a recession, then that's not really all that helpful to determine, where metals markets are going or where manufacturing markets are going. So I'm going to kind of put the stake in it now and say, it doesn't really matter whether or not we're in a recession or not. Maybe we should look at other indicators, which we're going to do here in the next few minutes. But what I do want to cite, the reason why whether or not we are in a recession will matter is I'm going to to place a little bet right now. And speaking of the shorter hair that I used to have, I'm going to say the first of two things to happen, whether or not Ohio State loses a football game or the NBER declares recession, I am going to cut my hair. So if Ohio State has a phenomenal season, the NBER never issues the recessionary warning, I might wind up like cousin It from the Addams Family over there on the left-hand side. If Ohio State starts out on a poor foot and we get beat by Notre Dame, I may be bald by the time we have our next cup of joe. So we'll have to see how this plays out. But I'm officially saying whether or not we're in a recession doesn't really matter. So we're going to dive into some other details here. So we talk about this pretty consistently in each of the cup of joes because I think it's really important, and it's a good macro start to really kick off where we are on the manufacturing side of things. And as we go from left to right, we're looking at August of 2021 to July of 2022. And you can see, alphabetically working our way down the list, as we go from left to right, you can pretty easily see that the colors are getting lighter. We're going from deep greens to lighter greens into some yellows and even seeing some reds now. That's just an overall sign that nearly every region of the world is experiencing a slowdown in some capacity. For some nations, that means a slowdown of growth. For other regions of the world, that actually means contractionary territory. And a couple of things I want to point out. One is if you look maybe, call it like 7 to 12 down, basically your European region, you look at France, you look at Germany, they've actually moved into contractionary territory on a month-over-month basis. And we'll cite some of the reasons why I think that is. You work your way, 3 down from the bottom, the United States, we're still in growth territory, but admittedly, it's significantly slower growth than where we would have been, say, 3-4 months ago. So whether or not we're in a recession, it certainly appears as though we're heading into slower manufacturing conditions as we sit here in August. Now, I know I said recession, not recession, doesn't really matter, but what does matter is, where we're going with regards to the Federal Reserve and its rate hike trajectory, because ultimately the Federal Reserve is trying to do its best to tamp down inflation, which has been running rampant for the better part of a year at this point. What we're looking at here in this chart is going to be the white line, which is the headline CPI numbers. So that includes energy and food. And then what the economists call the core CPI, which excludes food and energy prices, which as many of you know from listening to Cup of Joes in the past, energy and food prices are pretty darn elevated, and they are leading to much higher headline inflation. Now, one of the things that Jay Powell has said in prior Fed meetings and Fed minutes is that one of the things that he likes to watch and a lot of economists like to watch is, in fact, not the headline CPI number, but in fact, the core CPI number. They tend to like it because it tends to be less volatile. It tends to, extract out some of those items that can be, much more peaky and trophy. So it just smooths out some of the data. And if you look at this, the reason why I think that's important is if you look at the blue line here, for the last couple months, we've actually seen a couple month-over-month declines in core CPI. And that is starting to provoke this question of, if core CPI, as we roll through time, roll through the next couple months, if core CPI continues to work its way down, perhaps closer to 4, maybe sub 4%, could the Federal Reserve, in fact, take its foot off the brakes with regards to rate hikes? That's what's beginning to get priced into some of these markets. And if you look at the stock market, certainly things have rallied a bit over the last 30 to 45 days. And a lot of it's centered around that idea that, maybe the Fed doesn't, in fact, want to continue this aggressive rate hike cycle if, in fact, we are slowing down from an economic standpoint. And then similarly, the other thing, and this would be one of the key points as to why the NBER would say we are not in a recession at this stage, because jobs numbers are quite strong. Unemployment numbers are low. And what we're looking at here in this chart is ultimately the JOLTS job openings data. And this is going all the way back to 2001. We've seen record high numbers, about 11.7 million job openings were posted in recent months. Now, what we're beginning to see, and it's not much, we're still at very, very elevated levels from a job posting standpoint, but I think it's worth noting that we are coming off those record highs. And if you open any news outlets over the last couple of weeks, you've probably seen many tech organizations, a lot of startups, things like that, have announced pretty widespread layoffs. And then moving away from kind of the startup world, certainly seeing Google, Apple, Microsoft, a lot of big name entities, some of the biggest companies in the world, either announcing marginal layoffs or announcing hiring freezes. So I think it's hard to argue that the jobs market is still, running extremely hot. It certainly looks like it's cooling off a little bit, but it just seems as though it hasn't cooled off enough yet for the NBER to raise that flag and declare a recession. But I think, jobs data, inflation data, those are going to be the two key metrics that we're going to be watching as we roll through the next couple months to determine how high interest rates need to go in order to fully and effectively cool off market conditions.
Hey, Nick, in previous, you've talked about kind of that diversion between technology and we'll call manufacturing, making things, right? You mentioned it's kind of a revenge of the old economy. Do you find the manufacturing job market is getting stronger than the flip side, right? You said there's some layoffs there. Does that matter?
It depends. So if you look at some of the job opening data and peel back the onion and look at the details, what was interesting was a lot of that data was really coming from the IT and tech sector. It was coming from the retail side of things. So you think about clothing retailers and things like that. Admittedly, on the manufacturing side, there was a little bit of a decrease in the construction side of things. So I think if I was going to cite any area of the manufacturing world, it's perhaps slowed down incrementally worse than other sectors. It's the construction side of things. But outside of that, I would argue that we're still seeing a bit of this revenge of the old economy where, things never really got too frothy within the jobs side of things within our world. So if there's going to be a correction, it's going to be much softer within our world as well. Conversely, earlier this week, for those who don't know the company Robinhood, which is kind of a startup stock trading, crypto trading application, they just recently announced layoffs of 23% of their entire workforce. So that's thousands and thousands of people. So that kind of gives you an idea of where the haves and the have-nots are within these layoffs in this cycle. Now, one other thing that could potentially be leading to a little bit of this hope that inflation is going to start coming down is this chart, which is a couple pretty important indicators that have been, at least up until recently, moving to the upside. That's crude oil and that's diesel fuel. The white line is going to be your West Texas Intermediate crude oil price, which is, as of today, right around $88, which, as you can see, takes you back to basically the lowest levels since pre-Ukraine invasion. So that's a pretty notable move that in the last 2 months, we've gone from, I'll call it $120 a barrel all the way down to 88. So some of that's been fueled by certainly demand destruction, a little bit of softness within the global markets, certainly a little bit due to the fact that the United States has released barrels of oil from its strategic petroleum reserve in an effort to try and bring prices down. So those factors are certainly playing a role as we sit here today. We're still at pretty elevated levels. 88 is still not exactly a low number, but it is notable when you see 30-ish dollars coming off the price of crude oil in the last 2 months. And then similarly, diesel fuel, which is going to correlate pretty heavily to all refined products, so gasoline and things like that. You can see it's very heavily correlated to the price of crude oil here in this chart, and it's come off notably as well. So a bit of good news on the inflation side of things, that things could be cooling off on that side of things. Now, unfortunately, the other aspects of the energy world are not cooperating so much at this stage. And that would be, kind of this realm of heating, cooling your home, running manufacturing equipment, things like that. So we're talking about natural gas, electricity, coal prices. Those markets are all extremely elevated as we sit here today. And what we're looking at here in this chart is going to be the price of natural gas in the United States, which is shown in the white line. And it doesn't look like it, but $8.10 for natural gas is actually pretty darn elevated for US natural gas prices. The reason why it doesn't look like it's very elevated is because the price of natural gas. And again, this is US dollars per MMBTU. So it's the same unit of measurement. In Europe, it's almost 10 times as high. So again, if you're thinking about, us having pain with regards to, electricity bills or running manufacturing equipment, well, multiply that times 8 and you basically run into the situation that Europe's currently in. So a lot of that's due to the fact that they have less energy security. Obviously, the Russia-Ukraine issues adding fuel to that fire, but it's certainly notable. And when we think about that ISM PMI data that we showed on the chart just a couple of slides ago, my gut tells me that this energy as a wrecking ball theme is going to continue to exist and probably going to continue to rear its ugly head in the coming months, most poignantly within European markets, and I'd say maybe second and third world nations as well. It's going to be less so felt within the United States because, again, we have better security around our energy resources. But it's going to impact, these things impact global markets as well. But again, elevated in the US, but much more exacerbated within Europe. And then maybe more staggeringly, if you look at electricity prices, this is looking at both German and French electricity prices. This is going back as far as I could go. You can see that historically, these electricity prices were somewhat stable, right around $50 per kilowatt hour. They're up, call it 8 to 10 times what their historical norms are. So again, these things can be destructive to both sides of the equation. On one side, yeah, this could impact the ability to, consume products, but it's also going to impact the ability to make products on a cost-effective basis. So keep that in mind here in the coming slides as we get into, specific metals markets, because these things do matter when you think about how are we going to make aluminum, how are we going to, mine zinc. You can't do any of those things without power, electricity, nat gas, and so these are very notable moves. And unfortunately, as we sit here in August, we're not even in the heating season yet, and we're already seeing these types of moves. So stay tuned. These could get a whole lot worse unless we get some resolution. And that resolution may be additional supply or new supply coming online. Alternatively, it could be power rationing, demand rationing, and shutdowns of things, which could create some additional bottlenecks, supply chain issues as we roll through the coming 6 to 12 months. So with that said, we gave a brief introduction, but without further ado, I'd like to kick the ball over to Brian Crane, who is he's one of our product managers within the carbon side of things. He specifically covers the West Coast, so that's going to be basically the Pacific Northwest all the way down through Mexico for Ryerson. He's going to talk to us about what he's seeing within the plate markets. And the other thing I'll note is, for any of you who have questions about, mill discussions, lead times, anything he's seen in the physical procurement world, kick those his way, because he's going to have a much better insight into that than I will.
Thanks, Nick. Carbon markets have been, I think the best word to describe it has been crazy for the past couple of years, and we're seeing the definite opposite effect of what we saw. Now we're trying to find the bottom, right? And you and I have had these conversations, and I still think that right around 800 is that good floor for hot roll. If we want to talk specifically about the spread between plate and hot roll, I think that one thing that has kept plate prices a little more elevated has been the robustness of the end market users that plate goes into. So specifically, wind tower consumption has been high. We started to see a few of the first stage infrastructure projects be let. So bridge work, highway work has started to come through. If you're a West Coast resident, you'll understand that water transmission is a huge concern for us now. So we've seen a lot of water transmission projects come online, and those types of projects are keeping the plate mills busy. We did see somewhat of a correction over the past week with plate prices coming down a little bit, but they're still at a level that is historically quite wide over hot roll coil. And for now, we can expect those to kind of level out at these new levels and be at that stage for a while.
Hey, Brian, real quick. I mean, you talk about some of these infrastructure projects coming on and things like that. Would that indicate that these prices could stay high for a while? I mean, with some of these things just getting ramped up.
Yeah, I think they could stay at the new level that they came out at this week, and they could stay there for a while. I think what the mills are trying to make sure that they do is they're trying to stay in competition with what's coming in offshore. I think that's something that a lot of people that live on the coast have dealt with over the past couple of years, is that the import price has varied drastically with what the domestic producers are doing. But with infrastructure projects, a lot of that has to be domestic melt and manufacture. So that's going to keep the domestic mills busy. And I think we've seen that come to fruition.
Hey, Brian, question for you. So on the sheet side of things, obviously, there have been a number of different analysts who have talked about the coming sheet storm, or said a different way, just the additional capacity of carbon mills that are coming online here in the coming, let's say, 6 months to a couple of years out in the future. Is there much capacity being added in the foreseeable future on the plate side of things?
Actually, no. There has not been as much investment in plate mills that we've seen. Some of the new carbon flat roll mills are going to make sizes that are close to a plate size, but your traditional plate mill plate sizes have not seen the kind of reinvestment that the flat roll side has.
Interesting. Yeah, which I think is fascinating as we look at this chart and consider what it means, because ultimately this is looking at spot hot roll prices relative to plate. And you can see on a historical basis, they've been pretty darn correlated. Sometimes hot rolls at a premium, sometimes plates at a premium, but generally they're moving somewhat in sync. But we've certainly seen that massive deviation. And, I think certainly the end market demand on the plate side linked to infrastructure and wind towers and things like that can certainly play a role. I think the other thing that can play a role is just what we just talked about, which is on a relative basis, there's just a lot more capacity coming online within sheet that could keep that premium for plate, maybe not at $1,000, but certainly more elevated than where it's been in the past.
Yeah, it seems that every flat roll mill and every flat roll mill group has added 1 to 2 mills, or they've added capacity at mills. There's only been one new plate mill that has been under construction, and that's Nucor's new mill outside of Louisville, Kentucky, and that is expected to melt its first ladle of steel sometime in Q4. So only one new mill in the plate market is coming online. So it's going to have an effect on the market, but it remains to be seen what that effect will be. It's certainly not to the scale of what we see in flat roll.
Got it. So to put it into perspective, I guess relative lead times, how do they look in comparison between sheet and plate at the moment?
Hot roll lead times have contracted quite a bit. It's anywhere from 3 to 5 weeks. Plate is still in that 6 to 8. And if you're talking about heat treated plate, you've got some extended lead times there, and you've got a much tighter allocation source with heat treated products. But you've got a few weeks in between those two products. Hot roll relatively fast if you need it.
Excellent. And Brian, you mentioned the idea that the domestic mills are trying to keep in close step with foreign competition, import numbers. This chart, I'll let you speak to it, but ultimately it's the price of foreign products. So the blue line is going to be European plate prices. The white line is going to be U.S. plate prices. Again, you notice there typically is a somewhat of a correlation there, but go ahead and speak to that one if you like.
Yeah, I think it's a great slide to put in perspective the effect of the Russia-Ukraine conflict. One of the largest plate producing countries in Europe is Ukraine, and when that conflict kicked off, it really put a hole in European production, and European customers were scrambling all over the world to figure out how to fill their needs with that giant hole being taken out. I think it's somewhere in the region of 30% is what Ukraine supplied to the rest of Europe. So we see that giant whipsaw effect at the beginning of that conflict, and then it kind of came down as they found sources to import out of Southeast Asia and other parts of the world. But the high energy costs that you've been talking about have led certain mills to take a second look at what kind of production levels they're going to be at. And I think we've seen a lot of cooling in that Eurozone economy as you brought up earlier, which has led the plate production needs to kind of fall off a little, quite a bit. And, for the first time in a long time, we've started to see actually a couple of import offers come out of Europe, and it's been a really interesting plate market to have to work in this year.
So we got a few questions rolling in from the audience here. Brian, do you know the apparent demand for hot roll carbon versus supply, and the same for plate? So the supply and demand on both of those.
Ooh, that's a tough question to nail down. I would have to go back and check with some data points. I'm not sure that I can come up with that off the top of my head. Sorry.
Our listeners put you on the spot. Sorry about that.
That's okay. That's okay. We can come back. We'll get some answers.
And another one here. How much tonnage and when are you estimating significant new flat roll capacity coming on stream in the U.S. market?
I think we're going to see some of that come on at the end of Q3, and definitely we're going to see it in Q4. And it's not just in America. We're going to see a new mill come online in Western Mexico. So last year, Ternium, which is based outside of Monterrey, put in a new electric arc furnace, and we've seen production from that mill come on pretty hot and heavy. And this new mill, which is located in Baja California, will start producing full scale probably around September, October. So we've seen additional capacity at mills across the Great Lakes zone, and the brand new mill that Steel Dynamics has built in Sinton outside of Corpus Christi. So I'm not sure of the number off the top of my head, but it's a significant amount of new carbon flat roll capacity coming online. And also we've got mills that have added capacity, whether it's installing a new galv line at various facilities across Nucor, or it's an extra furnace here and there at places like Big River in Northeast Arkansas. We've seen quite a bit of new capacity come online, and Nucor is still in the beginning stages of building a new mill in West Virginia. So a lot of capacity coming online.
How much does auto impact hot roll?
Not to make it into a pun, but automotive drives the steel market, and it's
well done.
It's been the automotive production levels have been cut so hard this year that the absence of automotive is really being felt by what we see in hot roll pricing and what we see in capacity utilization at the mills and what we see as far as lead times. If it seems like every week we get a new news alert about another automotive production facility either being idled for a while, or they're going to take out another 5,000 to 7,000 units in a month. And the last time I saw a overview of how many automotive units we're not going to produce this year, I think it was close to 400,000 automobiles that are not going to come into production this year. And the amount of steel that's consumed by automotive is the vast majority of the overall market. So it's been a massive gap that automotive has left.
Yeah, it's interesting you note that. I actually listened into Cliff's earnings call just I think it was last week, and their CEO was pretty optimistic. Well, he's obviously recognizing that it's been soft up to this point. The outlook, he believes, and granted, he's talking his book a little bit, maybe a lot bit, because they're very heavy into automotive. But his outlook is pretty optimistic for automotive production demand over the next 3 to 6 months, it sounds like, which I think kind of lends to that hope, or that possibility that maybe the chips issue is beginning to improve a little bit.
Yeah, that is welcome news if it comes true. I hope he's right.
Excellent. Well, Brian, we're going to have you stick around unless Mike, are there more questions?
Yeah, there's one here, and what will the impact on price be on hot roll carbon based on the new capacity? So with all that capacity coming online, does that mean lower prices? I mean, where does that go?
It's a possibility. I think that what we've seen after these past couple of years is a reset on what raw materials input costs are going to be and what they're going to be in the future. And a couple of things have to happen. Automotive, we need to see what happens with automotive. and we need to see what's going to happen in other sectors. We see good demand across a lot of different end markets. I don't see just a complete pitfall where prices go to pre-2020 levels, but I think it's going to be interesting to see how all of that new production plays out. I think there's also a decent chance that some of that new production is going to find home outside of the United States and even maybe outside of North America. Just because Ternium put on a brand new mill, all of that production is going to be they're exporting to the Eurozone, they're exporting to Southeast Asia, they're going to South America. So it's not, and the Mexican domestic market has been fairly strong and remains to be. So it's a guessing game, and my crystal ball is unfortunately kind of foggy about that. But Nick, you may talk about it here in a minute, but the reset on raw material inputs plus what a mill can call a break-even point at production levels is going to be higher than it has been in the past.
Yeah, I think that's a great segue into my next slide. And Brian, we'll have you stick around till the end in case there are remaining questions. But no, appreciate all of the intel thus far. I think it's a great segue into this chart, which we did talk about last month, but I think we certainly want to revisit it because it touches on that last question, but also touches on the question of where might prices bottom, where could we potentially see something trough out and maybe rebound a little bit. What we're looking at here is going to be, to Brian's point, essentially the raw materials plus some margin that electric arc furnaces want to achieve when they make steel. So the yellow line is going to be scrap prices plus some theoretical spread of labor costs, energy costs, logistics, and their own margin, which we're kind of labeling $300. So scrap plus $300 gives you that trajectory of what the yellow line's showing. So, as we're watching the CRU as we sit here today, dip down into the low 800s now, we're beginning to close that gap on a spot basis between where the mills are happily selling steel and where the current spot numbers are. So, and when the one thing that we have not seen in the last 2 years is contango, which simply means upward slope in the futures curve. We haven't seen the futures curve look like this for certainly the last 2 years, where you actually have front month or spot prices lower than where the market believes they're going to be several months out into the future. And you can see that based on this curve. So, if we're using the futures market as a proxy of predictions, the futures market's kind of saying in the next, let's call it 45 to 60 days, that prices are going to trough out. And all of this kind of centers around this idea that at some point, the domestic mills, if they see prices go too low, they'll start to ratchet down on production because they aren't making as much money as they want to. The other point I would make to that question about does additional supply bring down prices? All things being equal, absolutely. If you have more steel supply coming online, all things being equal, that should bring down the relative price because you're adding more supply into the market. However, counteracting that, we have to consider the fact that if you're making more steel, where are you getting the raw ingredients from? You're making more steel from scrap. Well, scrap prices probably got to go up a little bit, or at least demand for scrap needs to go up, which probably tightens that market a little bit. So you do have this interesting push-pull dynamic of these new mills, these new electric arc furnaces that are coming online. Yeah, it might be a little bit of a dampening impact to the price of steel, but it could be cost supportive to the price of scrap. So switching over to aluminum, I know we talked about this chart specifically, which has the relative strength index down at the bottom of it. Again, as a reminder, the relative strength index is sometimes used by traders as a gauge of momentum. I think last month when we looked at this chart, things were pretty darn oversold, and the relative strength was actually below 30, which was that green line shown very faintly down at the bottom of this chart. But no doubt about it, over the last 3 months, with China being locked down, with the stronger dollar, with the Fed hiking rates, we've had a pretty aggressive storm that's brought prices back down to earth in a very quick fashion. Now, the question is, are we beginning to trough out? There are some things that would suggest that we're beginning to find a little bit of consolidation around these levels. So we got as low as about $1.05, let's call it, and we're currently sitting at about $1.10. I do want to cite this chart, which is a new one for us. So I want to take a minute or two to describe what we're looking at. This is what's called a cost curve. And I'm not trying to insult anybody's intelligence, but I do want to make sure it's understood. A company called Wood Mackenzie puts this together. And what they do is they're literally going out to every single aluminum smelter in the world. And they're saying, how much aluminum are you going to make? How are you going to make it? What's your cost structure look like? And then they're constructing this curve based on how much it costs those producers to make aluminum. So as we look at the x-axis, left to right, that's essentially how much production capacity of aluminum there exists in the world today. So let's call it roughly 70 or 80,000 metric tons of smelting capacity. Looking along the y-axis on the left-hand side, that is the cost of production for making that aluminum. You can't see it, but going left to right within this data is a smattering of all of the various producers who produce aluminum in the world. Not every smelter is created equal. Some have really good power contracts. Some are using hydropower. Some don't have power contracts, and you can see that on the far right-hand side, what that impact can have to their ability, or in this case, inability, to profitably make aluminum. What I've drawn into this chart is that dark blue dot, which is basically where aluminum prices exist on the LME right now. And I know it doesn't look like much when I cite this, but the cost curve's pretty darn flat, working anywhere from about 20,000 tons all the way up to where we are. And what I mean by that is, if prices keep dipping lower and lower in a pretty quick fashion, the market ends up making a lot of smelters unprofitable. As we sit here today, it's estimated that roughly 23% of smelting capacity is underwater or loss making. So what happens when smelters become loss making? Well, they can hope and pray and hope that prices go back up and they eventually start making money again. Or a rational economist would say, in a medium-term situation, if prices stay around where we are, those producers who are far on the right end of the cost curve, they end up shutting down. So you end up getting this pseudo inherent floor in the price of how low aluminum can actually go, because if you start going too low, more and more smelters become unprofitable. And to put that into perspective, again, I mentioned the fact that the cost curve is really flat here in this area. So we're at $1.10 right now. If we drop to $1 on an LME basis, that goes from making 23% of aluminum smelters unprofitable to making over 50% of aluminum smelters unprofitable. So all of a sudden, you really start to raise the question of how many of these smelters are going to continue producing if prices stay down, even in these areas, even in this area, let alone go 10 or 15 cents deeper from here. So I think it's an interesting scenario. It doesn't always play out exactly the way the economists think it does, because sometimes production will stay online and produce at negative rates for short periods of time. But if you see that persist for 3, 6, 9 months, you end up getting a lot of smelter shutdowns. And already some of those smelters over on the right-hand side of that dot have announced production curtailments. So that I guess my point is that could provide a little bit of price support here in this general area of prices for the LME aluminum. What we're looking at on this chart is kind of the reverse scenario, which is it looks like there could potentially be further pain on Midwest premiums. Again, Midwest premiums is the premium to get aluminum ingot into the Midwestern portion of the United States. Two big factors that are driving the Midwest premium lower. One is the fact that LME aluminum has dropped. When you have a 10% tax on that material, which we do, the impact of that tax actually declines, which makes the premiums drop. The other notion is what's shown in this graph, which is looking at trucking rates. So this is the truckstop.com flatbed truck rate. And you can see the correlation is not perfect, but there is a general relationship between trucking markets, logistical networks, and Midwest premiums. And you can see where trucking markets are ultimately going, which is they're loosening up. The bottlenecks that we're seeing within the flatbed trucking industry appears to be normalizing in a fairly quick fashion. And assuming this relationship holds up, we should continue to see Midwest premiums creep lower. So a little bit of good news to potentially offset a little bit of that price support that we might see on the LME. Flipping over to our last metal on the nickel side of things. Again, I'm using the relative strength chart because I think maybe this time last month we were pretty deep into again, oversold territory. We were down in the low to mid $8 per pound range. We have bounced a little bit off of that. We're closer to about $10. We're still below, as you can see in this chart, we're still below the 50-day, 100-day, and 200-day moving averages, which again is a different way to look at momentum. So for now, it looks like we're kind of just going to bounce and toggle around this range of let's say $9 to $10. It kind of looks like. To reference the cost curve chart that I mentioned a couple slides ago for aluminum, for those who are curious, it's a little bit of a different story within nickel. And what I mean by that is we're not yet really digging too deep into the cost curve of nickel miners at this stage. We don't really start to do that until we get into the low $8 range. So once you get down into the low eights, call it 10% of production becomes unprofitable. You don't get down into the 50% type range until you start dipping below $5 per pound. So I guess my point there is that cost curve support that we potentially may see in aluminum, it's less of a factor within nickel, which could mean that we have further to go on the nickel side of things.